Hello traders, and welcome to our very first video in this extremely imperative technical analysis trading course brought to you by ArcNFX. In this first video, we're going to be covering the introduction to technical analysis, which includes 4 chapters: the definition of technical analysis, importance of technical analysis in trading, basic concepts of technical analysis, and lastly, the overview of technical analysis tools. So let's dive straight into the definition of technical analysis. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. It is based on the premise that market trends, including price trends, tend to repeat themselves over time. Technical analysts use charts and other tools to identify patterns and trends that may indicate future price movements. So basically, currency pairs such as GBP USD, Euro JPY, and commodities such as gold and silver and so on are known as securities, and these securities are analyzed based off of their past price movements and trends created, as this gives technical analysts a better insight into predicting the same future movements to trade and profit off of. Technical analysis can be used to analyze stocks, bonds, commodities, currencies, and other financial instruments. It is often used in conjunction with fundamental analysis, which examines a company's financial statements and other information such as economical data and news events to determine its intrinsic value and future movements. The basic principle behind technical analysis is that the market is driven by supply and demand, and that these forces are reflected in the price of a security. Technical analysts believe that the market is efficient and that prices already reflect all the available information about a security. Therefore, they focus on analyzing price movements and volume to identify patterns that may indicate future price movements. One of the key tools used in technical analysis is the chart. Charts can be created using various timeframes such as daily, weekly, or monthly, and can be used to identify trends and patterns in price movements. Technical analysts also use various technical indicators such as moving averages, relative strength index, RSI, and MACD, moving average convergence divergence, to help identify trends and potential buying or selling opportunities. Another important aspect of technical analysis is the concept of support and resistance. Support refers to a level where buyers are likely to enter the market and prevent prices from falling further, while resistance refers to a level where sellers are likely to enter the market and prevent prices from rising further. Technical analysts use support and resistance levels to identify potential entry and exit points for trades. In conclusion, technical analysis is a method of evaluating securities based on past prices and volume data. Technical analysts use charts and technical indicators to identify patterns and trends that may indicate future price movements. It is a valuable tool for traders and investors who want to make informed decisions based on market trends and patterns. Next up, the importance of technical analysis in trading. Technical analysis is an essential tool for traders who want to make informed decisions based on market trends and patterns. Here are some of the key ways in which technical analysis is important in trading. Technical analysis helps traders identify trends and patterns in the market, which can help them anticipate future price movements. By analyzing charts and technical indicators, traders can identify support and resistance levels, trend lines, and other patterns that may indicate potential buying or selling opportunities. Provides insight into market psychology. Technical analysis can also provide insights into market psychology. By analyzing price movements and volume, traders can gain a better understanding of how market participants are behaving and what factors are driving market sentiment. Helps traders manage risk. Technical analysis can also help traders manage risk. By identifying potential support and resistance levels, traders can set stop-loss orders and limit orders to manage their risk and protect their capital. Improves trading performance. Technical analysis can also help traders improve their trading performance. By using technical analysis to identify high profitability trades and manage risk, traders can increase their chances of success and achieve better trading results. Overall, technical analysis is a valuable tool for traders who want to make informed decisions, manage risk, and improve their trading performance. Whether you are a beginner or an experienced trader, technical analysis can help you gain a better understanding of market trends and patterns and make better trading decisions. Next up, basic concepts of technical analysis. In this chapter, we will cover some of the basic fundamental concepts of technical analysis, including trends, support and resistance, chart patterns, and technical indicators. Trends. Trends are one of the most important concepts in technical analysis. A trend is a general direction in which a market or security is moving. Trends can either be up, down, or sideways. Technical analysts use various tools to identify trends, including trend lines, moving averages, and chart patterns. Support and resistance. Support and resistance levels are another key concept in technical analysis. Support refers to a price level at which buyers are expected to enter the market and prevent prices from falling further. Resistance refers to a price level at which sellers are expected to enter the market and prevent prices from rising further. Technical analysts use support and resistance levels to identify potential entry and exit points for trades. Chart patterns. Chart patterns are visual representations of price movements on a chart. Technical analysts use chart patterns to identify trends and potential buying or selling opportunities. Common chart patterns include head and shoulders, double tops and bottoms, and triangles. Technical indicators. Technical indicators are mathematical calculations based on price and volume data. Technical indicators are used to identify trends and potential entry and exit points for trades. Common technical indicators include moving averages, relative strength index, and MACD. Overall, these are some of the most fundamental concepts of technical analysis. By understanding these concepts, traders can gain a better understanding of market trends and patterns and make informed trading decisions. And lastly, overview of technical analysis tools. In this final chapter for video 1, we will cover the most common technical analysis tools used by traders to analyze market trends and make informed trading decisions. Charts. Charts are one of the most basic technical analysis tools. A chart is a visual representation of price and volume data over a specific period of time. Technical analysts use charts to identify trends and potential buying or selling opportunities. Moving averages. Moving averages are a type of technical analysis tool used to smooth out price fluctuations and identify trends. Moving averages are calculated by taking the average price of a security over a specific period of time. Common types of moving averages include simple moving averages and exponential moving averages. Relative Strength Index, otherwise known as RSI. RSI is a popular technical analysis tool used to measure the strength of a security's price movement. RSI is calculated by comparing the average gains and losses of a security over a specific period of time. MACD, Moving Average Convergence Divergence. MACD is another common technical analysis tool used to identify trends and potential buying or selling opportunities. MACD is calculated by subtracting the 26th period exponential moving average from the 12th period exponential moving average. Fibonacci retracement. Fibonacci retracement is a technical analysis tool used to identify potential support and resistance levels. Fibonacci retracement levels are based on the Fibonacci sequence, a mathematical sequence in which each number is the sum of the previous two numbers. And lastly, Bollinger Bands. Bollinger Bands are a type of technical analysis tool used to identify potential overbought and oversold conditions in a security. Bollinger Bands are calculated by adding and subtracting a multiple of the standard deviation of price from a moving average. Overall, these are some of the most common technical analysis tools used by traders. By using these tools, traders can gain a better understanding of market trends and patterns and make informed trading decisions. That is it, guys, for this introduction to technical analysis video. Be sure to understand the basics of technical analysis before moving on to our second video, where we will be going over the different types of charts that traders use, including bar charts, line charts, and the most popular, candlestick charts.